A lot of people are short on cash, right? People need money to buy. They don't have enough money to buy, right? So, in order to help buyers with that are short on cash, we have here a couple programs that we have in house, okay? And then some programs that we work with the state. So the first one that we have in our bank and a few other banks have it. It's actually a pilot program. It's called Fannie Mae Home Ready, and it's actually $6,000, or they lowered it to 3,000, depending on income limits. It has AMI limits. So basically, they have to make under a certain amount of money. But if they qualify and they're under 120 AMI, which is the average median income, 120% of the average income in the county, they can qualify very easily for $5,000. And we also give them 1.5K, so $1,500. So $6,500 in total in assistance if they qualify for that. Okay, so that's a straightforward program, depends on the income limits. And then we have through the state, we work with Florida Housing, which right now they have two programs. You may be familiar because Florida Housing is the agency that gives Hometown Heroes. Since Hometown Heroes is not available right now, we are working with the other two programs, and I've done many of these loans. One of them is a bond, and the other one is a TBA. The difference between both of them is that one of them takes household income limits, and the other one takes income limits based on whoever's on the application. But they both give $10,000. So, I believe the income limits for Miami-Dade are around 115,000, around there. But it depends if we're going with TBA or with the bond program. So that's another good program that if a client is short on cash, we can give them $10,000 in assistance. And then we also have an FHA zero down payment option, okay? So this is a great program as well, because they can literally put zero down. They can get all the 3.5% and buy, right, just basically paying the closing costs. That's it. And then the closing costs can be negotiated from the seller. So basically, they can buy with very little to no down, no money at closing. So that's a solution. Those are some solutions. We're going to talk about them in a little bit for the cash to close, the clients that are short on cash. Okay. And then something else that I have here, I pre-screen all your clients on the phone. We do a very good job in getting them on the phone and determining if they qualify before we even have documents. We have some tools that are proprietary that we can tell if your clients are qualified, and these tools, they mirror the DU system, the approval system that conventional and FHA have. So if the client tells me, if I ask them, hey, what's your income? Are you making, do you make a salary? Is it hourly pay? Whatever. And if what they're telling me is accurate, then pretty much what I tell you, and when they send me the documents, if it's the same, it's going to be the same pre-approval amount that I'm going to tell you over the phone. So it's a pre-screening process that we have before we have documents to help you guys determine if you guys want to go and show the person properties. Because a lot of times these people don't send you documents, and you want to get them engaged, you want to show them a property. With this, you're going to know if it's worth it. And you're going to save time. I might tell you, hey, don't show them properties because they might not qualify. Most likely, they're not going to qualify. Or, hey, go show them properties because they will qualify. So we have a solution to high interest rates. Something that a lot of people are doing right now is a 2-1 buy down. Have you heard about the 2-1 buy down?
No.
No? Okay, I'll show you guys about that in a little bit in more detail. And then I have the Home Buyer Express program. Okay? The Home Buyer Express program is a very cool program. It's something that we do here that we fully approve your client before they go under contract. Okay, we're gonna get them fully approved so that once they go under contract, they're gonna be able to put in an offer. Sorry, before they go under contract, we're gonna be able to put in an offer with a loan commitment. So we're gonna have a loan approval when you put an offer instead of a pre-approval. So we tell them we're gonna with the full approval, we can tell the seller we can close in 17 days. Okay, and we're giving them the guarantee that they're gonna close because they're already approved by underwriting, right? So we got a faster closing, and that's gonna help you also negotiate with the seller because we tell, hey, we got an offer. It's almost like a cash offer, and we can negotiate and we can close very quickly. So that's something else we're gonna talk about now a little bit. So the Home Ready first. I'm on the, wait, am I controlling this?
You were.
Wait, no. I just switched the screen, but it's not. It's not searching here. Let me see something. You sure it's mirroring my screen?
Yeah,
Cause it's
it's
No,
okay.
his is not.
I know.
So,
It's working. Here.
yeah, it's not. Let me try. Should I just reconnect? Cause this is my screen right now.
Yeah. Try to reconnect.
Got stuck, sorry.
That's fine, you can read it from there.
Yeah, so the home ready first, the program I was telling you guys about is you can get up to $6,500. They just put an income limit, so if you're above 120 AMI, you can only get $3,000 in assistance. They just changed the rules for that. And then that program, the Home Ready First program, is available in all Miami-Dade County, West Palm Beach, Palm Beach County and Broward County. Also in the Orlando, Kissimmee, Sanford areas and the Tampa areas as well. So if you have a buyer in those areas and they fall under those income limits, then you can get the Home Ready First program. And like I said, this is not a program, this is a program that very few banks have. I think one of the other lenders that have it is guaranteed rate, but there's only like 10 lenders that have this, direct lenders. So this is something that, you know, we offer here and it's in-house, okay? The second program that we were talking about before, that we're just gonna dive more in detail now, is the 10K Florida Housing Bond and TBA program, okay? The 10K program, it's a $10,000 down payment assistance for first time home buyers, okay? And it's, no, yeah, it's from the same agency, but it's not Hometown Heroes. Hometown Heroes right now, there's no funds for it, but when it becomes available, we do offer Hometown Heroes. Hometown Heroes gives you up to 35,000. So this program is the 10K, $10,000 down payment assistance, okay, for first time home buyers. And you get $10,000 in assistance, but it is repayable. You do have to pay that money back. Just like the Hometown Heroes, the buyer is gonna have to repay the loan if they sell or refinance the property. Okay, so it is not forgivable, but it is a very good solution for the buyer that is, you know, doesn't have that much money to buy. They need some extra funds, and you know they're not gonna sell or refinance in the next year because they will have it due. Then they can use this program to buy. It's zero interest. The money, the $10,000 is no interest, and it does not have any payments. Okay, so it just until they sell or refinance. I can show you after the income limits. They're around like 100 and I believe they're around under 120,000 a year. Okay, depending on the county, all the counties have different limits. Okay. So the minimum credit score for that program is 640. Okay, 640 credit. For the Home Ready First, the first program I told you guys, it's 620. 620 minimum credit. And it's only with a conventional loan, the Home Ready First, the first program. The 10K bond and TBA is allowed with FHA, conventional, and VA loan. Okay, so the Home Ready First, you guys can only do it with conventional. And the 10K Florida Housing Bond and TBA programs, you can do it with FHA, conventional, and VA. Okay, so those are two different programs. And then I have also, I also have on the next page, the FHA zero down mortgage. Okay, this is a great program. Okay, this is also a great program because you can get the full amount of down payment assistance, either 3.5% or 5% down payment, right? And it comes in two forms, right? So you can get the 3.5% as a repayable or forgivable option, or you can get the 5% repayable option. Okay, so basically, it depends, the differences between them, you're gonna have different interest rates. The cheapest option on the interest rate, you're gonna have the lowest interest rate on, is the 3.5% assistance that's not forgivable, that's repayable. Then it's the 3.5%, then it's the the 5% forgivable, and then the 3.5% that's not forgivable is the most expensive one. Okay? The forgivable, sorry, the 3.5% forgivable is the most expensive one, because obviously they're giving you that money, you don't have to pay it back. So the ones that are repayable are cheaper. Obviously, the 3.5 repayable is the cheapest one. Okay? And then the ones that are repayable, they do have monthly payments. So it is a second mortgage, and they do have monthly payments. Unlike the Florida bond, right? The TBA and bond, that one does not have any payments. But this option, the repayable, does have monthly payments. So they will have to qualify with their first mortgage and the second mortgage payment. So this would be an option for people that absolutely have no money and they do not mind paying a little bit higher interest rate. And that also they're gonna know that they're gonna have a second payment, right? They also have the forgivable, but the forgivable, the interest rate is kind of high. So they would have to decide what's better. I mean, we'll do all the comparisons for them. But this is just, I would say, high sevens. High seven, 7.8, 7.7, the forgivable. So I mean, they would have to decide for themselves if they want to do that. And then also it had it probably has a little bit higher closing costs. So it's just, in my opinion, what I've done in the past the most is the 3.5 down repayable option. It's just you're gonna get the best price. So the interest rate is set by the program. It's not a regular interest rate, right? It's a specific interest rate for this program. And then the minimum credit score is 600. Okay, 600 credit score for this. The guidelines are FHA guidelines. So whatever the FHA guidelines are, this will follow that. Okay. So this is also a good program. I usually use the first two options, and then if they do not have anything else, we go with this one just because, they have the extra payment, the rate is a little higher and stuff like that.
That's great.
But it's still we have an option for everybody, So if someone doesn't have cash, at all, nothing at all, we can still put them with FHA 0 down. Okay?
But that does not apply for your construction.
No. I mean, actually,
Because I know that sometimes when you don't qualify, you have a customer that doesn't qualify with the lender de la constructora,
they let you use
they
your
let
credit.
you use.
Exactly. Yeah, and a lot of times it's because they might actually qualify, but sometimes the lender is not considering something or they're not doing something right, and then they do qualify. So you can check with another bank, and that's the case, right?
But is that the case with you guys or no?
With what?
If I have a customer that does not qualify with
They can come. You mean taking them with us? Like bring them to me?
with that program?
We can try to, I would have to check, I'm pretty sure you could do it, I would have to check if you could do the FHA 0 down with a new construction, but I'm pretty sure you could, as long as you have a certificate of occupancy on the property and it's finished.
Right.
Then we can do the financing, it shouldn't be a problem, it shouldn't be. Okay, so, and this is something, now this is very cool. I've never seen any bank that has something like this. This is called the My Path to Own program. Okay, I think Edwin, we went on a meeting with Edwin and he actually heard about this. It's really cool. So your clients that you have, that you get them, you send them to your lender, they have their own bank, you tell them, hey, you don't qualify for anything. Maybe try again in 6 months or in a year. And that's it. And you you call them 6 months later and they might have told you, no, I already bought. Or hey, I'm not interested in buying anymore because they got demotivated, right? Because of all that time they spent just thinking I can't buy or nothing like that. So this is a great tool. My Path to Own is for the people that do not qualify now. Okay, the people that don't qualify. What we're gonna do is that we're gonna put them on the path to be able to buy. So what I do is, let's say I have someone that doesn't qualify. I tell them, hey, you don't qualify, but you can qualify if you do this, and this. I'm never gonna tell someone no. That's it. No. You do qualify, but you have to do this, and this. So what we do is we do a plan for them. Let's say it's repair your credit. You have to repair your credit. Maybe you have a credit person we can recommend them to. You have to get your credit up to this, and we recommend you pay these cards down to get your credit score up. Also, you're probably gonna need a raise or get a cosigner to qualify. If they don't have anyone, hey, I'll look for, they'll take some time to find a co-signer, whatever it is. If they have to, pay down some debt, we'll tell them, hey, pay down this debt, but we make a plan for them. And once we make the plan for them, we'll connect them with a HUD counselor, a government home ownership counselor that's gonna help them and guide them through the process to get ready to buy. And we're also gonna send them some courses to do. They're gonna take 3 courses, 3 homeownership courses. Once they are ready to buy and they finish those courses and they get those certificates, we're gonna help them and we're gonna give them, once they're ready to go, we're gonna give them $4,000 in down payment assistance. Okay, so basically what we're gonna do is we're gonna give them the plan. They're gonna follow the plan. They're gonna connect with the HUD counselors, and they're gonna do their trainings, their online courses, right, to get ready to buy. Once they get ready, they need to get ready to buy with the recommendations we give them. Once they do all the recommendations we give them, and they're ready to buy, and they do those courses, they're gonna qualify for that $4,000. So that's an incentive that you guys can tell them, hey, if you have the person that tells you, hey, I don't know if I'm gonna start buying, I'm gonna wait to get ready. We tell them, don't worry about it. I'm gonna get you pre-approved. We're gonna get you pre-approved with my team. If you're not ready, don't worry about it because we have a plan that we're gonna get you on the path, my path to home ownership. We're gonna get you on the path to buy. We're gonna connect you with, if you're not ready, we're gonna tell you exactly what you need to do. We're gonna connect you with these HUD counselors. We're gonna give you the trainings, and at the end, we're gonna give you money for your down payment and closing costs. Okay, so that way you stay connected with the people through the whole process. And another thing is that these counselors that we're gonna connect them with, they're not gonna put them with another bank, another realtor. They're gonna send them back to us when they're ready. When they're finished, they're gonna guide them back to us. So they're not gonna just, hey, go here, go with this realtor. What's that? No, they're gonna guide them back to us. So we're gonna follow them through the whole process while they're getting ready to buy. Okay. So it's called My Path to Own, where they can do, we can do all this stuff and give them at the end $4,000 to buy. Okay. You guys like that program?
That's a really good program, sure.
Yeah, Gordon tiene uno así.
Okay.
Ujú.
The builder.
Yeah. Dear Gordon, solamente Dear Gordon.
Got it. So you got the high interest rates, right? High interest. A lot of people right now are saying I don't want to buy because the interest rates are very high. And we're in a special market because right now the sellers, they're more likely to give concessions and give money to the buyers because there's not that many buyers. So the sellers are more likely to say, hey, here's some money for your closing costs. And a lot of buyers don't know that you can actually take that money and you can do 2 things. You can do a permanent buy down your interest rate. But what's more effective is called a temporary buy down or a 2-1 buy down. Okay?
Pero that's with the...
With a seller credit.
Sí, pero la tasa de interés ahí no es fija, es variable, que es el problema, ¿no?
No, no variable. Click the next one.
Oh, sorry.
Perfect. So this is a FA, let's say, for example, you have an FHA loan, right? 30-year fixed FHA loan. And let's say the rate, this is old, right? But right now they're like in the low 6. But let's say the rate, for example, was like a 6.75. Okay, that's their 30-year fixed rate. If they don't do the buy down, that would be their rate for 30 years. Okay. Now, if we get them a seller credit, I'll tell you what the amount would be right now. If we get them a seller credit, we can lower their interest rate 2% the first year and 1% the second year. They get a discount on their rate for the first 2 years. But this is a fixed.
How much is the sales credit?
I'll tell you right now. So the first year will be 4.75, let's say, and the second year would be 5.75. So their payment would go from their principal and interest payment would go from 2,594. The first year would go down to 2,087. It would drop $508 a month. Per year, the first year they're gonna save 6,094. The second year, their payment will drop to 2,334, 260. So they'll get a 4.75 and a 5.75 the second year. That's a rate that if you get a regular fixed loan, you're not gonna get a rate around that time, around there. And if right now, it would be around 4.3, what they would get, because
Right.
if you go down from today's rate. So the way you know what the cost or what you need to negotiate from the seller is exactly the savings on the buy down for the first 2 years. So basically what we're doing is we're saying, hey, Mr. Seller, can you please buy us the interest rate that for the first 2 years? Can you pay for that? And that savings that they have for lowering the interest rate 2%, 1% the second year, the total amount is 9,215. That's exactly the same amount that we would have to negotiate from the seller. So what this is this is having the seller pay for the interest rate reduction for the first 2 years. Because it's equivalent to the savings that they're gonna have. So a person that's sensitive on the payment and says, I don't wanna pay more than 2,500, right, all in. Well, with this, you're gonna have around a $2,500 payment the first year with taxes and insurance. And the second year, you might be at 2,700, but you have the first 2 years to refinance when rates come down.
The first 2 years or after?
You can have, but I'm saying that you're not gonna get to the payment, your actual payment until the third year. So
Right.
3 to 30. Now keep in mind, you tell them this is not an adjustable rate mortgage. Your actual rate is 6.75 and your actual payment is what it is. But you're gonna have a significant decrease in the first 2 years. So that's pretty much what the cost of the buy down would be, exactly what you would need to negotiate from the seller to be able to do this. And this is a good tool for the buyers that, like I said, are sensitive with interest rates and they're sensitive on the monthly payment. And they say, I'm not buying because there's no way I'm not gonna pay this. Well, you tell them, hey, look, if you explain, I explained to them exactly how I explained to you here. If you do this, this is what your payments will be the first 2 years, and if you don't refinance between the third year, you're gonna have your actual interest rate for 30 years fixed, which is this.
But anyways, you could refinance after the
Yeah,
third year.
but if we don't get it, anyways, if you don't get a buy down, your interest rate is this one from the first day. So at least with this, you're getting a
No, it's a great incentive, at least for the first 2 years que están recién
Exactly.
con todo, te van a subir los taxes, maybe blah, blah,
Ajá.
blah. So, yo hice un buy down, pero
Exactly.
era variable, no me gustó.
Yeah, esto no es variable, esto es un fixed loan, but the first 2 years, they have that discount. Now, when they refinance with us, they refinance for free. No lender fees. Everything else on the bank side, they still gotta pay all their other stuff, but on the bank side, we don't charge them anything. So that's another benefit they have. And we service 90% of the loans that we have. So basically, when we give the loan out, more than likely, we're gonna have the servicing. And we're gonna be able to give them a very competitive offer to refinance because we wanna keep the loan in-house. We wanna keep servicing them. So we're gonna do a free refinance. And then also, more than likely, we'll offer them a very, very aggressive rate when they're gonna refinance. Okay? So that's that. Homebuyer Express. Okay, there's a few banks that have this, but Homebuyer Express is a program that it's great here because it actually has a guarantee. I didn't put it here because we're still working on the guarantee, but basically it's the full approval. We're gonna fully approve the client. Every time you send me a client, we do the pre-approval, and in the back end, I'm sending your client into underwriting so we can get the full approval. Once we have the full approval, the loan commitment, I'm gonna be able to tell the seller, and we're gonna be able to tell seller, you or whatever realtor's working, that we can close in 17 days, and that it's a guaranteed closing. You can even waive the loan commitment period on the contract. Okay, so basically you're giving them almost a cash offer. It's almost a cash offer, and a lot of times, you're fighting with another offer, and they might take the other offer. If you tell them, hey, we're already approved, and the other person has a conventional pre-approval, you tell them that you don't know if they're gonna close. We have a underwriter. Look what the underwriter said. Look at the conditions right here. This is easy. I have the conditions right here. All that's pending is an updated bank statement and appraisal to do the appraisal. That's it, and we're closing. Obviously, all the title stuff. But on the financing side, we're gonna have everything ready to close, okay, before.
Worst case scenario,
Mhm.
cambia de trabajo, whatever.
That's something else that would have to be reviewed. Assuming nothing changes, right? Nothing changes, they would be ready to go. If they change jobs or they quit their jobs, that's something else. Because at the end, before they close, they're always gonna have to verify that they're working where they are working, right?
Right.
So this is something to, obviously, well, if they're gonna get approved, nothing changes, everything stays the same. And then we'll be able to close without any other conditions. If something does change, they change the jobs, and we're gonna have to review the new jobs they have, you know?
Pero, I mean, es muy atractivo.
Yeah.
Vamos a decir, el peor caso, que
Yeah.
vamos a decir, yo pongo se pone una oferta con esas condiciones, cash,
Mhm.
porque ya tenemos todo
Exacto.
preaprobado o aprobado.
Claro,
No preaprobado, aprobado.
aprobado.
Situaciones pasan, ¿qué pasaría? ¿Tienen depósito? ¿Qué garantía tienen ustedes para el cliente?
Mira, esa es la parte del loan commitment en el contrato que ustedes toman la decisión. Si nosotros vemos que el cliente, obviamente nada va a pasar con el cliente, no va a calificar, no va a perder el trabajo. Si el cliente te dice, oye, más o menos me pueden despedir o lo que sea, entonces ahí tienes que poner un loan commitment period. Pero si no pones un loan commitment period y pasa algo por financing, estás en peligro, ¿verdad? Pero eso sería por algo, a mí nunca me ha pasado eso con un full approval, porque cerramos rápido y obviamente si vemos que el cliente no está más o menos, igual no vamos a poner, vamos a poner la oferta así, pero igual no vamos a waive y no tienes que hacerlo. Tú le puedes decir, mira, esto está, pues tenemos 15-day loan commitment period, solo por seguridad, pero ya está aprobado el préstamo, ¿verdad? Ya está completamente aprobado y aquí está la aprobación del underwriter. La mayoría de las veces cuando yo puesto con offers con los realtors que he trabajado, siempre ponen igual loan commitment period. Pero cuando quieren ser más agresivos así, hasta yo los he visto que they waive it. Porque ya sabemos que se va a hacer. Entonces, con eso van a hacer un par de cosas. Vamos a poder cerrar en 17 días, que va a duplicar los cierres que van a tener, porque ahora ya no está cerrando en 30, 45 días, está cerrando en 17. Imagínate todo el tiempo que se van a ahorrar ustedes, or all the time that you're going to save, because we close in 17 days with the full approval, you're going to have so much more time to go out and generate new leads, prospect, show new buyers houses, right? You're not going to have that 30 to 45 day transaction. So it's going to save you a ton of time. You're going to do more closings. You're going to take away the uncertainty factor out of the equation. You're going to know that the person's approved. You're not going to be, is this going to close? Is the loan
association, actually.
Yeah, we don't know what's going to happen. Like, you're already going to know that it's going to close. And the escrows are safe. The deposit is safe because you know that they're already approved. So they're not going to have an issue with the finance, right? But one of the biggest things that I didn't even, I just skipped it now, is that you're going to be able to negotiate better terms for the buyer. Because when you have the full approval, you have more leverage to tell the seller, hey, we're gonna close in 17 days because we know that you need to close fast because you're buying another house, you're setting to buy. But we need this $9,000, $10,000 so that the buyer can do a 2-1 buy down. So this is where this ties in with the buy down. So if you say I gotta negotiate $10,000, the best way to do it is get the client fully approved, so that we can go ahead and tell the seller, our client's fully approved, give us 10K and we'll close in 17 days. And more than likely, especially how the market is right now, you're gonna get some sort of credit. Maybe not the whole thing, maybe the whole thing, or maybe more, depending on the house, the person, and the negotiation. But you're gonna be in the best position possible to be able to negotiate that if you're fully approved, okay? So this is an amazing, amazing tool, and I pretty much do it on every buyer, especially the ones that are super, like kind of gray area. Like you don't know, there's certain things about their file that are kind of, you don't have the 100% answer because in the guidelines, it doesn't say clearly their specific situation. We're gonna send it to underwriting and the underwriting is gonna tell us, no, this is like this, we need this condition. So we're already gonna know if there's an issue, we're already gonna know before you go under contract. Now, while you're under contract and you gotta have the loan approval tomorrow. We're already gonna know before. Okay, so that's the benefit for the Home Buyer Express, okay? Is there another page on this or no? Okay, Home Tracker. This is just something that I put there because we have this program in-house. Basically what this is just a real-time update for realtors. It's a program that we have that's linked to our CRM. It's linked to the program that we use to originate loans. And it's gonna provide you real-time updates on the transaction as it goes. Hey, we just ordered appraisal. The appraiser is set to go out this date to the property. Hey, the loan is now in processing. We're waiting for these documents from the borrower. Hey, we just submitted the loan to underwriting. Okay, when it comes back, hey, we just received the loan commitment. It's basically an update, real-time update, so that you guys are never in the dark when it comes to, hey, what's going on with my buyer? With this, obviously you can always call me, but with this tool, you guys are gonna have real-time updates on your phone. This is just something added that's gonna help you, because I know a lot of realtors complain that their loan officers or people are not giving them updates, they're lost in the transaction, they don't know what's going on. Well, you can always call me, but you're always gonna stay informed on what the process is and what step they're in the process, and if there's any pending documents, hey, we're waiting for this document from the buyer, okay? So we have this, I have this calculator, when I give you a pre-approval, instead of just giving you the letter, I'm gonna give you a calculator. It's a custom-made calculator for every single client. And you're gonna be able to put in all the numbers for the properties that they see. Like the purchase price, the annual tax for the property. And it's gonna tell you your monthly payment and your cash to close. And that way you can see if you have a pre-approval for 400,000, sometimes you don't know if they qualify for a little higher if the taxes are lower. But they might, because you see the pre-approval is actually based on the monthly payment. It's not based on the purchase price or the loan amount. It's based on the all-in monthly payment. And what affects the monthly payment? The purchase price, right? The tax, the property taxes, and they can vary from 1% to 2% of the purchase price. This can increase and decrease your pre-approved loan amount by $65,000 on a $500,000 house at a 6.5% interest. So you're not gonna have that pre-approval letter that says, hey, you're pre-approved for 400K. No, you're gonna have the dynamic calculator that's gonna tell you, you're gonna put in the numbers, 400K, you're gonna put in the tax, and you might be able to go higher, 430, 440 with a very low tax.
Well, we just had that
With
this season.
association and everything.
Yeah, and if the association goes up, the pre-approval might go down, but you're gonna know everything on the calculator, so you're not gonna have to wonder, hey, is he gonna qualify with an association of 300 or 400? And if the taxes are over 1%, or if they're under 1%, this is gonna be tied into their debt to income ratio. And it's gonna be within their parameters. So you're gonna know at all times their monthly payment, their pre-approved amount, what they're approved for, and their cash to close. And there's another tool that we have on the bottom of the calculator that you can even put if you can pay off certain debts to go higher.
So an example, that's cool.
I'll show you after, yeah, we'll show you some examples. But on the bottom of the calculator, let's say you want to go higher instead of denied. Sometimes, by paying certain debts after closing, they can go higher. So you can put an X, hey, pay off this credit card, and then it's gonna say approved. And then you tell the client, hey, look, if you pay this credit card, your cash to close is gonna go up $1,000, but now you qualify for this house. So this is a real pre-approval. And you're never gonna find, you're always gonna know at all times if they qualify, and you have the option to pay credit cards, and you can see if the numbers change, you're always gonna know at all times.
Well, we just got in a contract now with one of them, and Homestead, he was approved for 415, and when we went to Sunrise, he got approved for 465. So you see the major difference between just the areas, how much he got approved for.
And think about, he would have discarded that property. If he wouldn't have known that, he might have not even put it on the MLS, because he would have been like,
450.
why am I even gonna look at that property? He's not approved for that. But since I showed him the calculator and he's been putting all the numbers in, he's like, oh, he qualifies for this one. So you open up your search way more,
No, that's super.
than just getting a regular pre-approval letter. So that's that, that's just how it looks, but I'll show you a little bit, it's basically the same information. And I wanna talk a little bit about condos, cause I know you guys wanted me to talk about that. Have you done condos? Have you?
No finance.
Condos is a different animal, it's a whole different animal. In Florida, it's just completely different to buy a condo, so there's two ways to buy a condo. And with finance, you can do FHA or conventional. Most of the time, you're gonna be in the conventional,
Right.
because very few condos qualify with FHA.
25%.
Now, conventional, there's the first thing that you have to look at is the budget for the association, right? Which is how much money they receive, how much money they plan to receive. And out of that money that they receive in assessments, how much of that money is going to expenses and how much of it is going into a reserve account. Okay, so for example, if the condo association does not have 10% of their income in a reserve account, then you have to do 25% down at least. You cannot be lower than that in down payment. Okay, if they do have, and that's called a limited review. Okay, 25% down if they do not have the 10% reserves. If they do have the 10% reserves or more, we can do a full review. And what is the full review? The full review is they can do 5% down as long as they have the reserves. Now keep in mind, that's not the only requirement. That's not the only requirement to do 5% down. They also have to meet the other requirements of a condo and financing. Like for example, they gotta do a condo questionnaire. And they have the association has to fill out the condo questionnaire. It's gonna ask them questions on the stability of the structure, if there's any repairs that need to be done, right? If they pass their 40-year inspection. So there's a lot of things on the questionnaire that they have to pass. But when they do have 10% reserves, it's a good indicator that the condo is good financially, and most of the time, not every time, if they do have reserves, they would meet the other requirements.
And so that's step one. Step one.
Step one is getting
To put in the offer, if you see reserves, you could do it, and then obviously, once you're in the contract, you do the.
You have to check those.
You do all those things, but at least for step one, the 10% very important.
And why is that? Is because when you go to be able to get the other documents, the condo questionnaire filled out, the master insurance is another thing. We have to ask them for the master insurance policy of the building. And a big thing right now is that a lot of these policies have a high deductible on the insurance policy, and they can't have more than 5% insurance deductible. If they do, they don't qualify. So we have to ask them for the master insurance, they have to fill out the condo questionnaire, and for that, they will charge you. The associations, they charge for that information. Usually it's like $200 to $400. So we do that if we're under contract. If we don't have the offer, we're not gonna pay for nothing because you don't have any contract. But what you can do, your due diligence before you go under contract, is that we look at the budget, and if they cannot put more than 5% down, we have to check, make sure that it does have 10% reserves or more. Okay? So, yeah, so basically, just a short way to think about it, budget 10% or more reserves, you can do 5% down. If it does not have 10% reserves, you gotta do 25%. Okay, there's also other stuff that have to be checked once you go under contract, so it's not even guaranteed. And then FHA, okay, FHA, they have to have 10% reserves. You can't even, if they don't have 10% reserve, you cannot even think about it. And there are FHA approved condos, there are very few, there's like 7 buildings in Miami. There's not many. And if they're not approved, we can approve them. We can approve 1 unit in the building. It's called the FHA spot approval. And we have to go through the same process as a full review. They have to have 10% reserves, and we have to check all the other requirements. But then they have some additional rules. So it's a little bit more difficult to get it approved with FHA. That's why if the borrower can put 5% down and they have a decent credit score, the first option is going to be a full review. We look for condos that have 10% more reserves, and we try to go conventional. Okay, I'm going to show you how the budget, how the reserves are calculated on the next slide. Okay, so this is just yeah, I just had that there from a long time ago. So basically And this is just some numbers I put, just to give you an example. So the way the reserves are calculated is very simple, okay? It's just taking the income from the assessments, okay? And we do this, you don't have to calculate it, but just, I'm doing this to. Exactly.
No.
So we get a budget, and on the first line, you're gonna have income, and it's gonna say assessment income. The assessment income, we're gonna take that amount, and we're gonna take 10% of that, and it's not gonna show you here, so I'm gonna explain what this is. 10% of that, they gotta have 100,000. If it's 1 million, they gotta have 100,000. Right, so if they have 90,000 in reserves, it's not enough. They don't have enough. They gotta have at least 100K in reserves. Always 10%, they gotta have at least 10%. If they don't have that, you gotta do a limited review, 25% down, convention. That's the only option. Now, with a conventional loan, this is just a little step, additional step. Not everybody knows this. And realtors don't, most of them do not know this rule. With a conventional loan, you can subtract certain expenses from the income. So for example, if this income right here is $1 million, the assessment income, and the association pays they have expenses of water and sewer of 100,000, right? Let's say they pay the water bill for everybody. Some associations have that. And the bill is $100,000. That's what they're assuming. You're gonna subtract this 100,000 from the income, okay? And you're gonna have 900,000. So now you need to have only 10% of 900,000 instead of 10% of 1 million. So you need to have 90,000 instead of 100,000. Okay? So if this association has 90,000, then you will qualify for this. And you could do 5% down payment. That's only with conventional that you can subtract expenses from the income.
Realistically. Visto.
Yeah.
There's a few.
They have-
The HOA sometimes, the condo HOA.
No, it's common.
Yeah,
I know that most of them, I mean, no Kisco, pero.
No, not here.
Yeah.
This is
Pero
just
muchos otros buildings que sí incluye, por ejemplo,
Ajá.
Promenade en Kendall,
Ujú.
dejaron de aprender de ellos pagan el agua, pero no
entonces
sé
ya
si.
tú puedes quitar eso.
Ya hay que ver el budget y si entonces lo están pagando, agarramos el budget y entonces we take out the water and sewer expense from the income and then we get 10% of that subtracted amount and then if they have 10% of that, it would qualify with a full review to do 5% down on the
Pero
budget.
that's a requirement, $100,000, ¿o no?
No, and this is just an example.
Oh.
Yeah, no, it's just like
10%.
it's 10% of this amount minus whatever expenses that you can
Whatever
deduct.
expense.
But remember, this is very specific stuff. It's not all these expenses. You have to consult with me because not everything you can deduct from the income. I'm just showing you kind of like what I do here, but so you guys can know that it's not just 10% of the income. It's not just that. There's a couple things that we can subtract from the income.
Yeah, but for FHA, 10%.
For FHA, you cannot subtract anything from the income. From FHA, it's just
10% of
the
the.
10% of the income. So whatever the income is, if it's $1 million, you need 100,000. You need 10%. And this condo wouldn't qualify because it has 90. But with conventional, this same condo, you can subtract 100,000, and with 90 reserves, now you qualify. You see? So if the condo had 95, you wouldn't be able to do this, but you would be able to go with conventional.
So when you have a listing, it's important to get the budget so you could know when you list it, if it's FHA, if it qualifies FHA or if it doesn't. That way you get more buyers in there. Or you don't waste your time either.
And you would also have to know like the other things on the condo.
Yeah.
With FHA to see if it qualifies. But you can get a very good idea with this of what it's gonna be. You can also check on the MLS, the closings that have happened, if they have been FHA or conventional closings in the past. And usually, if you see conventional in the last month or two, usually you know that at least you can either do a full or limited review. Because sometimes, there's many times that condos you cannot do anything with them. You cannot do 25 or 5% down. Because they have litigation lawsuits against the association, or they have something that's wrong with the structure, that they won't allow to be financed. So there are some times that you can't even do a 25% down. And you have to do a non-QM loan for a non-warrantable condo. We do those too. For the condos that do not qualify for some reason, we have loans to give that we can give to the clients. And they're usually 20-25% down payment. but we can finance. I've financed before with master insurance policies over 5%, up to 10% deductible. If you have that with conventional or FHA, it's not allowed. I think FHA, I gotta double check, but I think FHA, I just read that the other day, they allow over 5% deductible, but I do have to double check that. But anyways, a non-warrantable condo for any reason, we also have financing for that, if they don't qualify with these two options. Okay? So that's pretty much that, and then, I mean, I got the CRM, I mean, Edwin uses Follow Bus. We keep track of every single client that you guys send me, and, you know, just following up like a hawk, making sure that we don't miss a date, we put action plans, and, you know, we have tags to separate our clients. You get semi-monthly reports of your leads. Hey, this is the status on this one, this is the status on this client, we need documents from this one, so you will know exactly where your clients are and what stage they're in, you know. So that's pretty much, I think that's it, pretty much. I think you want me to?
Can you go over a little bit?
You want me to open up a calculator?
Yeah, let me pull up,
The calculator?
yeah, let me see that for example. Would you have?
No, it was just on closing costs, to explain a little bit. Like what the buyer will pay at a closing.
This is a non-QM loan, right?
That's well, I think that was something to mention. We'll do that later, that's fine, don't worry about it.
Okay, so basically, on the financing side, yeah, it's a lot of points.
Yeah.
2.7, but anyways, on the financing side, the costs for a loan, right? You have the first thing is when you finance a loan, you gotta choose an interest rate, right? And whatever interest rate you have, there's a certain number of points associated with that interest rate, depending on the day in the market. So for example, you can get a 6.375. And that 6.375 is gonna cost the borrower 0.3 or 0.5, or maybe even more, 0.75 of a point, 75 basis points, right? That's a fee, a closing cost fee that they would pay to get that rate, to lock that rate. Or they can get a 6.5, I'm just giving you an example, a 6.5 with half a point, right? Or whatever it is. Every rate has a different number of points associated with it. The lower the rate, the higher the points they're gonna pay. So many times you'll see a client, and we give them all the options. We tell you, look, you can get a 6.3, a 6.5, or a 6.6. The 6.5 is with no points. The 6.6, you're getting a credit of like $500, lender credit, and the 6.3, you have to pay half a point. The difference in payment is this between the 6.3 and the 6.6. And the difference in cash to close is this between the 6.3 and the 6.6. So the closing cost from the bank, whatever point that they're gonna get, whatever point is associated with their interest rate, that's something they pay. And then on lender fees, which is underwriting and processing, and technology fee, every bank charges them. That's standard. It's under $1,800. So $1,800 is what they pay the bank, plus whatever point or fee they have to get the rate that they want. Everything else is third-party stuff. You got your appraisal, right? You gotta pay your appraisal. The company that we use, they charge $500 for appraisals. So that's pretty low. Usually appraisals are anywhere from $600 to almost $700 on an appraisal. Everything that has to do with the title company, the fees for the title company. So you got your title search, you got your closing fee from the title company, right? That could be a few $1,000s. They gotta issue the lender's title insurance. That's the title insurance that's gonna protect the buyer and the bank from any damages on title for up to the amount owed on the loan. That's the lender's title insurance. It's required because the amount that you owe, it needs to be insured, because the bank needs to make sure that that amount is insured for any title damages, right? The owner's title insurance is not required. So you got that, and then you got your prepaids. You gotta prepay your first year of your homeowner's insurance at the closing. You gotta load up your escrow account with a few months of property taxes and a few months of insurance. And then besides that, you have your recording fees. The sellers pay the deed taxes, the recording taxes on the deed. and the buyer pays the mortgage taxes, and the recording fees. And then besides that, just that's pretty much it. The only other thing would be if the buyer is paying any commission. On any gap of commission, and any broker fees from the broker. And the owner's title insurance, it's not mandatory, but the owner's title insurance is pretty much. Everybody goes.
I think when it's a loan, it's mandatory, no?
No, not the owners.
Not the owner?
The owners is there, cause that covers their equity. The lender's title insurance is the amount that's mandatory, because that covers the loan amount, up to the loan amount.
Got it.
So it is required, 100%. But yeah, the owner's title insurance, they don't have to go with it. It's pretty much, it's optional, right?
Okay, we put the calculator for you.
Yeah, so pretty much, this is just an example, right? Let me see if can I go.
Yeah, okay.
Alright, so let me see DTR. Alright, so let's say for example, if the person here. You would just change the cells that are in yellow, right? The orange cells. Let's say, for example, this person has a 400,000. They find a property that's 400,000. That's a little too high. Put 3%. Yeah,
This one's
it's
Carlos.
60%. It's 60. Okay. But it's Carlos, right? Let's lower this. Okay.
So this is a calculator that we have currently with one of our clients.
Okay, so for example, right?
Right.
Okay, I'm not gonna do this too much. I think it's just like.
No, no, Zoom is fine.
Let me zoom out a little bit. Okay, perfect. So here you have, for example, you find a property, right? And we're gonna change the purchase price up here. We're gonna change the annual tax. You can put the annual tax here. The insurance for the property and the HOA. And it's gonna tell you right here, your monthly payment, right? Your cash to close, this is estimated. And it's even gonna tell, here are some debts at the bottom. We're marking these to be paid off. The Macy's card, the rooms to go, city furniture, and this one, PVC. So all these cards are being paid off at the closing. These are the balances. And this total balance is gonna go up here and it's gonna add to the cash to close. Because they're paying them off, right? They're paying these off, so it's gonna sum that to the total cash to close. This is including the debts. And now they're able to go higher. For example, if we take this off here. Okay, so check this out. This property right here, they're denied, right? But they would only be able to go to, let's see, if we 340 the beginning. Yeah, they would only be able to go to 340, right? If you go to 350, on this specific scenario, they're denied. So let's try it. Now they're denied. So let's pay off this small credit card on the bottom. They should be approved with this one. Now they're approved. Just paying one credit card, just with $200. Now. And the cash that goes is 28,000. Now they went up $10,000 just by paying off a little credit card of $200. Who would have known, right? If they just pay that one off. All right. Let's say we go to 360,000. Denial. We went from 340 and now we're at 360, right? Let's mark the other credit card to pay off. That one's still not enough. Let's pay the other one. That one's still not enough. Let's pay one more. Macy's. So now you're approved. So now with $1,700, you just went up 20,020 because they were at 340. $20,000 more. And then let's say 370. 370. Now this DTI now at 57.5. Let's try paying off this additional card. 5 cards. It's still not enough. They would have to pay. Let me see something. You can take that one off, and you can go for one higher here. That's 1,700, and now they're approved by paying $3,541 at closing. They went up from 340 to 370. And let's say, for example, you found a property and the HOA, let's leave the HOA at 200, but let's say the taxes,
No, for sure taxes.
that's a really low tax, but sometimes you find the taxes that you could use for the qualification, right? For like, let's say they find like something like a $2,100 tax, right? And if the property is higher, let's go to 380. They're still approved. You just went $40,000 higher. Let's do 385. 385. That would be the limit right there, 380 basically. So at 380,000, you just went from 340 to 380 by paying off 3,500 and the taxes being lowered.
Está genial. Te da los multi-pay.
Exactly.
Todo el mundo pregunta, ¿cuánto va a quedar para
No solo eso, mira esto, mira esto. Esta casa aquí, you see this house right here? This house right here that pays 3,026, the cash flow is 32, including the debts that they have to pay. And let's say, no, this is too high for me, the payment. Don't worry, we can get you fully approved. We can try to do the 2-1 buy down. What would the numbers be for the 2-1 buy down? All right, let's see right here. Look, it's gonna take the information from the first one and take it to the second one, and it's gonna show you the payment. The third year, which is their actual payment, but the first year, if we lower the rate to 4.5, they're gonna have a $2,559 payment. The second year, they're gonna have a $2,700 $787 payment, and the third year, 3,026. It's gonna tell you what they saved the first year per month, the total amount per year. It's gonna tell you what they save per month the second year, the total amount for the second year, and this is the credit that you would need to get from the seller. And you would know all that information just by plugging in these four things: the purchase price, the annual tax, the monthly hazard, and the HOA. You're gonna know everything.
Está genial. Porque si no.
So yeah, so this is the difference, and this is the value that we want to bring to you guys, so that you guys are, have these tools that are going to help you once you're with your buyer. Because a lot of times you go under contract and the buyer goes under contract, they don't even know their payment.
Yeah, they don't know how much they're gonna pay.
And then they find out what their payment is and they want to cancel. No. With this, I do a Zoom call with every single client when we get them pre-approved, and I go over them with this. I go with them.
No, yo tengo una cliente, la hija mayor de mi esposo, o sea,
So I do a Zoom call and I tell them, hey, look, just so you have an idea of what this is, we're gonna do some examples. Let's go on Zillow and let's find some properties. And then we're gonna find a property, I play with the calculator with them, and the clients like this. They really do like this because they feel like they're in control and they see how it works. They see that you're not trying to hide anything from them. They see exactly how their payment is calculated. They see what it means to pay off a credit card. They see your cash flows. They see, hey, if we can get a 2-1 buy down, what would our payments be? How much will we need to get from the seller? They're gonna know all that stuff. And we're gonna give one of these for every single client that we have. So pretty much, yeah, that's everything.
Good.
Do you have any questions? I mean, do you have any questions? I don't know.
That's it.
There's still someone online?
Vanessa.
Vanessa.
No. Tú vas a mandar el.
I'll send it to her and then she'll send it to you guys. And then, if you guys have any questions or anything, I'm available. Here's my, I can send you. And then if you can send me everyone that was in this meeting, their information, I'll go ahead and send them my info. Y también, todas las tarjetas mías, pues sí. ¿Quieres? Dale a alguien.
Perfecto, gracias.
Okay.